Okay, this is the start of class 4. We're going to talk about risky bond pricing. And it's just an extension of regular bond pricing. So last time, this is what we did. We did an Excel exercise where we price a bond that pays, I believe it was $50 coupons, and then we played around with the interest rate, and we used the interest rate to generate discount factors, and we played around with the interest rate, and we looked to see what effect it had on bond prices. Um, let's see. This is the spreadsheet we did. So we had a bond with $1,000 face amount, 5 years till maturity, $50 coupons per year, paid twice per year, so it was $25 every 6 months. And we laid out all the cash flows, coupons, and principal. And then we generated discount factors based on the interest rate that we assumed, which was 4%, it looks like. From the discount factors, we calculated the present value of each cash flow. And then we summed up all the present values to get the total present value of the entire bond. And then we expressed it as a market price. And then we played around with the interest rates to see what happens to the price if interest rates go up, what happens to the price if interest rates go down. So the next task is we're going to price a risky bond. And what we mean by that is in the past we've been assuming that all our investments are 100% safe. And now we're going to relax that assumption, and we're going to say what happens if there's a chance that we don't get paid back. What if the bond defaults? Um, so here's the exercise. Using the same bond as before, what if the coupon and principal payments are risky? Let's suppose there's only a 90% chance of each cash flow occurring. Build a spreadsheet to calculate the probability weighted present value of the bond. And then the next thing we're going to do is we're going to go back to assuming that the cash flows are 100% certain, and we're going to see how much would we have to raise the interest rate to reach the same present value as the bond with 90% probability weighted cash flows. So anyways, what we're going to do is we're just going to work off of this spreadsheet that we already made, and we're just going to add to it. So I'm going to move this stuff down so we have room to the side. And we're going to have a column called probability of the cash flow occurring. And we said this is going to be 90%. Actually, I'll put an input up here. 90%. And then we said for each of these cash flows, we're assuming the probability that it actually occurs is 90%. So I'm going to copy this down. So for this first coupon, the probability that it occurs is 90%. For this next coupon, the probability that it occurs is 90%. For the face amount, the principal cash flow, it's also got a 90% probability. So all these cash flows have 90% probability. And then we are going to have another column that is the PV weighted, the probability weighted PV. So let's just write some comments here so that we know what these column headings are. Probability of cash flow occurring. Okay. And this one is probability weighted present value. So for the probability weighted present value, we're going to just multiply the probability times the present value. Pretty simple. And then we're going to copy that down. And then we're going to use this same formula to find the total present value of the bond with 90% certain cash flows. So I'm just going to copy and paste. And all this is doing is summing all the present values. But it's lower now because it's only each cash flow is only 90% certain of occurring. And then the market price is going to be the same formula as well. Looks like I need to freeze a cell here. I need to freeze E1 before I copy it. So the market price is the total present value divided by the face amount times 100. So 94.04 is the market price, or it's another, which basically means 94.04% of par. Okay, so we did the first part of the question already. We built a spreadsheet to calculate the probability weighted present value of the bond. And we found that it is $940 or a market price of 94.04. So let's look at the second part here. We're going to go back to assuming that the cash flows are 100% certain, and we're going to try to figure out how much do we have to raise the interest rate to reach the same present value as the bond with 90% probability weighted cash flows. So, I actually should have had you do this before, but why don't you go ahead and try to do this second part on your own. You can pause the video now, and then when you're ready, once you've given it a try, you can hit play and you can see how I do it. Okay, so here's how I'm going to go about this. I'm going to have, I think, 3 more columns here. So first of all, another column for total cash flow, and we're just going to use these cash flows from over here. We're basically just bringing them over here so that the spreadsheet will be easier to read later. So I'm going to copy this down. So these are all the cash flows in the bond. Next, we're going to have a separate set of discount factors. Now these are going to be different than these discount factors because what we're doing now is we're going to have a new interest rate that is higher than the 4% we were using here. And we are going to try to figure out just how much higher it needs to be to get the market price the same as the 90% certain cash flows. So, for reasons that we will explain later, we're going to call this interest rate the discount rate. And again, for reasons we'll explain later, the discount rate is actually going to be composed of two components, two component interest rates. First is the risk-free rate, and that is simply equal to this. As I said, we never really talked about this before, but up until now we've been assuming that all our investments were 100% safe. And so we were using, without specifying it, we were always using the risk-free interest rate. So that's what that is. Actually, I'll move this up. Where's a good spot for it? Up here, maybe. Okay, so that's one component of the discount rate. The other component is the risk premium, and this is going to be an input. So let's start with a risk premium of 1% for right now. So the discount rate is simply the sum of the risk-free rate and the risk premium. Okay, so the risk-free rate here, we're just setting it equal to whatever we were using before. The risk premium is a new input, completely new, and then the discount rate is just the sum of those two components. Now, for the discount factor, we're going to use the same formula as here, except we're going to use the discount rate rather than the interest rate. So we're going to use N3 rather than I2. So I'm just going to copy this thing. And what I did here is I'm copying the text of the formula rather than copying the cell. And that's going to allow me to keep all the cell references exactly the same. And the only thing I'm going to change is I want to use this instead of this. I'm using the discount rate instead of the interest rate. And let's just double check that everything else looks right. So the discount factor is 1 over 1 plus N3, which is our discount rate, divided by E4, which is our compounding frequency. And then that is raised to the power of E4 times A9. So compounding frequency times the number of years that have elapsed. So that all looks right. If you're having trouble with that, you can refer back to the formula for the discount factor, which is, I'll show you right now really quickly. Let's see here. Just go back a few slides. Right there, that thing in yellow. 1 over 1 plus R over N raised to the NT. Okay. And then from there we should just be able to copy this formula down. So all looks right. And then we're going to have we're going to recalculate the present value using the new discount factors. So discount factor times cash flow equals present value. Copy that down. And then we're going to calculate the total present value just by summing it up. Okay, so it's 1,000 because our discount rate happens to be the same as our coupon rate. We'll change that in a second. And then our market price, so this is just summing up all the present values here, and then this is just dividing the present value by the face amount and multiplying by 100. So now the goal is we want to set this market price equal to that market price. Now the difference between this and this, actually let me freeze these cells really quickly here so this is a little easier to read. Okay. So the difference between these two is that here we've assumed that the cash flows are not certain, but we're using the risk-free rate to generate the discount factors. And so um, we end up, when we multiply by 90%, we end up with a lower present value than if the cash flows were 100% certain. Here, we got rid of these probabilities. All we did was instead we're just raising the interest rate that we use to calculate these discount factors. So we raise the interest rate, that causes the discount factors to be lower, which causes the PVs to be lower. And the question is, how much do we need to raise the interest rate to get the total PV equal to the total PV here? So let's just start playing with it. Let's see if I type in 2%. Gets us a lot closer. 2.3 gets us a little closer still. And actually what you can, rather than having to use guess and check, there's a tool in Excel. If you go to, on the menu bar, if you go to Tools and Goal Seek, you can actually have Excel guess and check for you. So what we want to do is we want to set this cell equal to this. So 940.42, and we want to achieve that by changing this cell. So we're trying to seek for the value of N21 to equal the value here, 940.42, by changing the risk premium, this value in cell N2. So I hit OK, and just like that, Excel calculates that the risk premium should be 2.41%, which gives us a discount rate of 6.41%, and that sets our present values equal using these two different methods. So basically these are two different methods for valuing a risky bond, and what we see is that if we assume all the cash flows have a 90% chance of occurring, that's the same as using a risk premium of 2.41% to discount the cash flows. So let's go back to the PowerPoint now and explain a little bit about some of these terms: risk-free rate, risk premium. Okay, so the risk-free rate, which we denote as R sub F, okay, so a cash flow is risk-free if it is 100% certain to occur. That is, there is no risk of default. And that's the assumption, as I mentioned, that's the assumption we've been making up until now, is that our investments are 100% certain to pay off. There's a 0% chance of default. If a cash flow is risk-free, then we discount the cash flow at the risk-free rate. So that just means that we use the risk-free rate to generate the discount factor to calculate the present value of the cash flow. What is an example of a risk-free asset? Well, there's a couple. U.S. government debt, that is Treasury bills, Treasury notes, and Treasury bonds. FDIC insured bank accounts. The FDIC is the Federal Deposit Insurance Corporation, and they basically will guarantee that your bank account is safe. The federal government stands behind your bank account up to $100,000. So if you have $100,000 in your bank account, let's say you have a bank account with Harris Bank in Chicago, and you have $100,000 in there, well, Harris Bank could go out of business, but the federal government is guaranteeing that they're gonna guarantee your bank account. So if Harris Bank goes out of business, the federal government steps in and makes up the difference to you. So it's essentially just as good as U.S. government debt. Anything over $100,000 is not guaranteed by the FDIC. And that's all. There's two risk-free assets in the world. So everything else has some element of risk to it, to a greater or lesser degree. So if a cash flow is not 100% certain to occur, then we must discount the cash flow at a rate higher than the risk-free rate. And we're going to call that rate the discount rate. So we're discounting the cash flow at the discount rate. And the discount rate is equal to the risk-free rate plus some spread. And we call that spread is either called the credit spread or the risk premium. So that's the end of the slides here. Now let's go back to the spreadsheet for a second, and I'll just point something out. So I'm going to zoom out a little bit here so that you can see the spreadsheet in its entirety a little bit better. So let's pretend for a second that you are a investor or a trader of bonds, and so you might use a spreadsheet like this to try to determine what the value of the bonds that you're trading are. Now this first method that we used, where we take all the cash flows and we multiply each one by some probability to get a probability weighted cash flow, it makes a lot of sense. It's very logical. It kind of goes step by step. But that is not how an actual market practitioner, an investor or a trader would go about this. Because all this information, the probability of each cash flow occurring, is not really accessible in the market. The way that an investor or a trader looks at it is they're going to take a given bond that they're interested in, and they're going to look at what's the market price of that bond. So let's say it's 94.04. Then they're going to say, okay, that means that for every $1,000 of bond, the bond has a present value of $940.42. So what they can do from that then is they can figure out what's the risk-free rate, and they can just look that up in the market as well, just by finding a treasury bond with a similar maturity. So they're going to look up and see U.S. government debt, something that matures close to July 1st, 2013, and they're going to say what's the interest rate on that U.S. government debt. Whatever that interest rate is the risk-free rate for that maturity. So let's just say they look up, they find a U.S. Treasury note with a maturity of July 1st, 2013, and that has a yield of 4%. So that's your risk-free rate. So now they've got a risk-free rate, they've got a present value and a market price, and what they can do is, and then finally, one last thing they're going to do is they're going to take the market price here and they're going to calculate what's the corresponding yield. So I mean, really simple to do. We did it right here. We've got a market price of 94.04. There is, that corresponds to a yield or a discount rate of 6.41. And if we were to change around the 6.41, that would change the market price. And if we change the market price, that would change the 6.41. So using a spreadsheet like this, they can say, okay, market price is 94.04. That corresponds to a yield of 6.41. And we also know, because they just looked, and they saw the risk-free rate for that maturity is 4%. And so they're going to deduce that the risk premium or the credit spread is 2.41%. So, and that's pretty much where they stop. What they're interested in is how much extra per year in terms of yield am I being compensated for holding this risky asset as opposed to a risk-free asset such as a U.S. government treasury note. So I'm going to go in the market, I'm going to buy some bond of some company. Let's say you're buying the bond of AT&T. I should be compensated something extra over and above the treasury yield because this bond has a chance of defaulting. These cash flows are not certain. So how much extra am I compensated? Well, in this case, you're compensated 2.41 percentage points per year extra. And that's basically where you have to stop because um, with all the information that you gather from the market, it's not actually sufficient to figure out what the probability of each cash flow is. Now, one thing that you could do is assume that all the cash flows are equally likely to occur, and then you could just do a goal seek to figure out um, what the um, what the average probability of all the cash flows occurring is. But in reality, each cash flow is not equally likely to occur. Um, you could think about it a couple ways. Um, right now, we're in the middle of an economic slowdown, so you could say that the earlier cash flows in the near term cash flows are less likely to occur because in the near term the company might go bankrupt because of the economic slowdown. However, if it makes it through the first couple years, chances are the economy is going to turn around and and the company will be on sounder footing, and the later cash flows will be more likely to occur. But then you could say, well, the really later cash flows, who really knows? It's 10 years away. Um, this company could be totally obsolete by then. And you could say the very later cash flows are less likely to occur. Um, so that's just, I mean, that's just one plausible explanation of why some cash flows could be less or more likely to occur than others. And so you really can't glean that information from the market. You can't figure out because all the market tells you is the price, and you know what the cash flows are. You know what the dates of the cash flows are. So from the price you can determine the yield, or from the yield you could determine the price. Um, from the yield and the risk-free rate, you can determine what the risk premium is. So what's the extra return that you're receiving for holding this risky asset? But beyond that, there's no way to really know what the probability of each cash flow occurring is. So we went through this little exercise using probabilities because that is kind of the fundamental building blocks, and it's a logical way of thinking about it. But in practice, this is the method that's focused on for pricing risky assets. So that about covers it for class 4. Um, Again, we went through this pretty quickly, so feel free to watch the video again if you have any problems. And then when you're ready, you can go ahead and play the video for class 5.